Hello and welcome to FidelityConnects. I'm Pamela Ritchie. It is only the 6th day of 2026 and markets are already giving us plenty to unpack. Fidelity's Global Asset Allocation team is watching closely to see how headlines unfold and ultimately the market reaction to them. So which themes are top of mind with our next guest and what's driving his optimism around Canada? Joining us here today to share some of the latest insights from the GAA team is portfolio manager David Tulk. Well, welcome to you, David. Happy New Year to you.
Happy New Year to you. It's great to be here.
Delighted to have you join us, and we'll invite everyone to join us in either official language. Live French audio interpretation is available for you as well. Let's begin with the state of affairs. There are lots of words to describe it, but one of them is sort of regime change, new world order. In a word, is it changing how you invest?
No, it doesn't. Fundamentally, we're still doing our process. We're still really focusing on diversification. We're finding lots of opportunities around the world, trying to play a lot of these macro themes. And I think as we start the year, I think the setup is pretty good. So we had a good year last year. It's been a couple of years, especially for the 60-40 portfolio construct, of really strong returns. And that is given largely through equities, but bonds have also done reasonably well in the last year or so. So I think it's just one of those years that it starts good, but I know there's lots of little roadblocks and lots of little speed bumps that we're gonna have to overcome, which I know we'll be able to unpack. But as it starts right now, I think our primary view on the world is fairly optimistic, and we'll do our best to try to stick handle around some of the things that will inevitably crop up this year.
Last year, ahead of the move, really, you were making sure that you were allocated internationally.
Right.
At the very beginning of last year, that was a head scratcher for many, or not what you were doing, but just it wasn't something on people's playlists at that point. It worked out incredibly well. Is that an area that you'll look at as strongly this year?
Yeah, I think it's a trend that will start to become better appreciated, especially among US investors. So that was really one of the big surprises last year, and was one of the really large portfolio shifts that we've talked about before, is that we started last year with a pretty hefty overweight to the US and to the US dollar. And as the early part of last year unfolded, it became very obvious to us that that wasn't the right positioning. So we made some pretty significant strides to move to being underweight the US dollar and also underweight US equities. And I think as we start this year, that was clearly the right move to make last year. But as we start this year, I think that trend could certainly continue, because I think a lot of the things that are happening under the surface continue to be US dollar negative. And I think as that theme starts to become better understood in the market, you might also see other investors try to position for that. And that could be an extension of the type of move that we have seen in the currency, because the US dollar is a longer term sort of cyclically driven currency, and these long trends, they can last 5-10 years. So I think we're still in the early stages of that. And again, a lot of that's catalyzed by what we're seeing out of the US administration and a lot of the stuff that we're seeing outside of the US as well.
When we think of the word broadening and a broadening trade, do you think that should be extended to an international trade? Because often we'll talk about sort of the other 493 and so on, but a broadening trade means what?
Yeah, there's definitely the narrow definition of broadening, which is itself a bit of a contradiction, but you think of it as in terms of the just within the United States, where it's obviously been led very much by AI-focused companies and growth more generally, and that broadens into value and small cap. And we can unpack that certainly, but I think the way that we've thought primarily about broadening is largely outside from the US to the rest of the world. So again, the positioning tilts that we have is still to be modestly underweight the United States, seeing more opportunity in Europe and Asia and emerging markets. And as you mentioned in the intro, looking more favorably towards Canada as well.
So let's sort of insert the discussion of interest rates into a dollar story, lots of other things as well, because it appears, and I think you have commented, or others certainly have commented on the fact that if we go back to which country or region is in which part of the cycle, the US is in quite a different point, and Canada, for instance, really got going quickly on cutting rates, and now here we are, it appears to be at the end of the rate cutting cycle. How does that bode for investing?
No, absolutely. So I think in the United States, this is also something that really keys back to the dollar story too. So, you've seen the Federal Reserve cut a couple of times, and their policy rate, it's fairly close to what I would say is generally neutral. And I think it's consistent with what the wider economy is suggesting they can do. So they could cut a couple more times But generally speaking, they're in the right neighborhood. But I think the key risk that will unfold, and this year is especially relevant, is that you're going to get a new Fed chair. And we're going through the candidates right now, and there's a lot of jockeying taking place both on Twitter and behind the scenes. But
it's like a presidential run for something.
Exactly.
It's going on forever. But
okay. Yeah, no, but we've been given some notion that there should be a decision that's made in the next couple of weeks or fairly early in the year. So what we'll end up seeing, I think, is then again the risk that monetary policy isn't being set exclusively for economic reasons, but there's now a political overlay. Because as we've heard from the administration, there's a very clear desire to see lower interest rates regardless of what's going on in the economy. So if the successful candidate for the Fed chair is sympathetic to that narrative, then again, you start to see interest rate cuts that, again, are largely driven by political considerations. And then that has a very clear implication for the direction in the currency.
Yes.
Not only is it raising fears of a lack of central bank independence, which again is sacrosanct to a well-functioning currency, but also again just speaks to that interest rate differential that's beginning to shift further away from the US dollar. And then that brings us to Canada,
yes.
where, as you mentioned, the Canadian rate cut story, I think that's more or less done unless something really goes wrong with the economy. So if you actually look at the way the market is priced today, there's some probability that the next move by the Bank of Canada will be a hike.
Right.
And part of that was catalyzed on a really strong GDP report. But again, when you look at where things sit, Canada moved early and moved by a lot. And now we're kind of working our way through a lot of the reasons why the Bank of Canada cut. So if the economy continues to remain on track, at some point you can imagine that would then necessitate the Bank of Canada to potentially take some of that stimulus away. Again, not tomorrow, not even in the first half of this year, most likely, but at some point it does serve as a reminder that central banks are inevitably cyclical. And at some point, you're going to start to see the other side of that. And that's one of the things that I think maybe not a 2026 story globally, but as a forward-looking investor, you just have to keep that in the back of your mind and not be too conditioned to just think of that central banks move in one way, and that's to cut interest rates.
And if that is later in the year, we think that might jive with towards the end of a trade talks, NAFTA, lots of different words for it, is being renegotiated. We know that we're kind of entering that right now, and probably some geopolitical moves will come to bear in those talks. We don't know to what extent, but I guess just tell us a little bit about the idea of whether free trade as we know it, I think a lot of people think that's over. Right. What might it be replaced with just at this point, or what are some of your working models?
Right. Yeah, I think in this sense, when we look at Canada and the negotiations around NAFTA, that could be one of those really big stumbling blocks that we encounter this year. So this is the year for the formal renegotiation of that agreement. Obviously, there's been a lot of stuff that's happened behind the scenes, and there's a lot of tariff applications and then removals and a lot of sort of saber rattling on that front that I think we've been unfortunately accustomed to at this stage. But this is really the year where a lot of that comes out. And I think what at minimum we'll need to brace for a fair bit of volatility, just reopening that trade debate that we thought that might have been sort of pushed to the side as the US was focused on other countries, but it is unfortunately Canada's turn and Mexico's turn as well in the spotlight this year. So that's something that we'll have to be watching very carefully and try to figure out where the rules end up landing. And I think ultimately what you really want from a Canadian perspective is just clarity. So whether it's tariffs of this or tariffs of that on this industry or that industry, whatever it ends up being, it just needs to be written down and put into place, because that to me really addresses the key source of uncertainty. And that's the hardest thing for corporations or businesses to really operate in, is a world of uncertainty when you're trying to make investment decisions and hiring decisions when you don't know what the rules of the game are when it comes to trade. But then if you think about the US and globalization more generally, and this is another important part to think about, is that I don't think we're going back to a globalized world. And that is something that, again, we've seen in bits and pieces in recent years. And it really comes down to the notion of how the US administration views its tax policy. Because if you remember, a tariff is just one form of a tax. So it can be used in conjunction with household taxes, corporate taxes, but really it's part of the mix. And
it's good to remember it that way. It's
entirely
one of the tax levers.
Exactly. And the desire for this administration is to primarily use that tariff lever to raise revenue, and they've raised a fair bit of revenue, to then fund other tax cuts more domestically. And that's kind of consistent with that sort of America First policy that we've seen recently.
Hello investors, we'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of FidelityConnects podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to FidelityConnects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
Do you think that it also, as we move to a less globalized world, one of the questions that's being asked is what either new trade deals or relationships or even, country ownership of pieces of companies looks like? We've seen a few examples of it. It clearly is something that the Trump administration is okay with, at least, in some cases. From an investor's perspective, is there anything to think about that? Is it in some way dilutive? Does it change the policy of a company itself because new people are owning it? How do you look at that?
When it comes to the individual companies, this is where, again, we really rely on our building block managers who are doing the security selection and trying to navigate a lot of those risks as they apply to individual countries. But if you take a step back, or companies, I should say, and if you take a step back and look at the country and the regional allocations, again, this is something that you really think of as reinforcing the desire for diversification. So you don't want to have all of your eggs in one basket, because ultimately you can get these policy decisions that can really cause a great deal of stress that aren't entirely predictable. And when we think about how we've allocated accordingly, again, we're trying to get that diversification across regions. And we also appreciate that there can be more regional stories that we can try to invest in. So when the world was very globalized and moved in like sort of one synchronous cycle, it's kind of hard to distinguish between regions because they all kind of move together. But now if you've got more fractures between countries, you can have a Europe idiosyncratic story that you can invest in. You can have something that's unique to emerging markets or different subparts of that emerging market basket. And that, as an asset allocator, is a lot of fun, because you can find these stories that can trade differently than what would be the case if you're just following one global cycle.
If you're able to follow international cycles, not one global cycle, spread out a bit, broaden a bit, what does it mean to the fears, perhaps from your perspective and other investors' perspective, about the AI bubble bursting, whether it is a bubble where there isn't? If you're not so concentrated in some of the big names, or maybe even some of the secondary names, because you can be more global about it, does that spread out that risk?
It does to some extent, but I think ultimately that is really an important theme that we'll also see unfold this year. And it's not calendar year specific per se, but as this investment takes place within AI, ultimately you need to find the use case to try to monetize a lot of this. Because as we've talked about in the past, we've spent a ton of money on CapEx. And when we talk to our analysts, and they're closer to these companies than I ever will be, they speak to that spending as being motivated by competition among the companies and still justified economically and financially. But at some point, the longer this runs, you're going to need to see that monetization take place. So it's something that we're watching. We've invested within the US, specifically around that theme. And ultimately there, we're really relying on those managers and those analysts that I spoke about. They're the ones that are going to give us a signal in terms of saying, well, this has run too far, or this has potentially further to run. And that's something that we will take and could potentially be a catalyst for a pretty sizable change in our positioning, just because it is a really important theme that will really define this year, and we want to be able to be on top of it literally every day.
Are you more exposed to it or more interested in it? You'll find the right word for this, but the energy, the sort of picks and shovels, the data center build out beyond the technology companies that are leading the way. There are also some of the data center owners as well. But what piece of it are you most interested in, most exposed to?
Yeah, at this point, again, it's largely down to our managers who look at the entire sort of universe of AI plays, either directly or tangentially or every combination thereof. And they're the ones that will pivot their individual portfolios accordingly. So using global innovators and listening very carefully to what Mark Schmel is saying and what he sees and where his opportunities are. So that does, again, two things for us. First, it gives us all the security selection he's able to bring into the portfolio, but also it's a signal to us to say that, okay, something's changing here, that we need to maybe make a larger, broader tilt, either out of those plays or out of the US or anywhere else. And we'll see how that unfolds, but that's what we're trying to balance today.
I mean, one of the things I think he says actually is energy. Right. And over the weekend, because the US has gone into Venezuela in the way that it has, one of the questions is there will be more energy on the market for North America at least, and maybe beyond that. But the other argument is we're going to need it no matter what.
Right. Exactly.
How do you parse through that piece of the discussion?
Yeah, I mean, this is the debate that a lot of people are having right now, that if you do bring Venezuelan crude oil into market over the next little while, and there's no guarantee that's going to happen tomorrow. There's a lot of infrastructure that needs to take place and a fair bit of money that will need to be spent, and that won't happen instantly. But does raise the concern, is this a direct competitor to Canadian crude oil, given that they're similar grades? And we spent a fair bit of time thinking about that as well. And I think the first observation to make is that, again, if the global economy holds up this year, there will be a lot of demand for energy, and that will be beneficial both to newfound Venezuelan capacity, but also existing Canadian capacity, and also with the AI trend, as long as that's still happening in the background, and can be positive for commodity prices, because we really haven't seen oil prices respond in the same way as we've seen other commodities. So there is some, at least historical evidence to suggest that oil could potentially catch up. So, tangentially, that's one of the reasons why we're a little bit more optimistic on Canada. But also when you just think about that competition between different countries when it comes to providing crude, a lot of the structure there that is kind of nuanced, but I think Venezuela can do a lot to access Gulf Coast refineries, but a lot of the refineries in the Midwest are still very much linked by pipeline into Canada. So
which is where we're selling.
Exactly.
Mostly.
So there's a little bit of a distinction there, but it also, again, serves as another reminder that Canada, we can't rely on the US to anywhere the same degree as we would have in the past. So if there's an additional catalyst to build pipelines to Tidewater on the West Coast, and to think about alternative trading partners as well, not just within crude, but more generally, this was another really clear example of saying, well, you need to think a little bit more holistically about how you trade with the world, and steadily reduce your reliance on the US. And we had a federal budget late last year that helped to sort of at least catalyze some of those priorities. And again, this will take time, but when you look at the delta and the rate of change, it is starting to move in the right direction. And that's another reason why we want to look more carefully at Canada as a way to play that as an investment thesis.
Come back to the type of horizon you're looking at Canada with. Right. At the end of last year, you and your colleagues at GIA will have said a little bit of a darkest before the dawn type feel to that. Are we going to get closer to the dawn? How do you want to discuss that?
Unfortunately, the sunrise is measured in quarters and years as opposed to minutes and seconds.
It's January and it's a little dark.
Yeah, exactly. We're waiting for that leap shift from daylight savings to maybe change things, but no.
Just the end of January.
Exactly. But more realistically, this is taking place, and it's just taking place very gradually. But we also know that markets don't wait for evidence to be sort of presented to them. Right. So markets are investing on the theme of progress and on the theme of improvement. And we've seen the TSX perform pretty remarkably well over the last year.
Astonishing.
Yeah. As long as that can kind of continue, as long as you're seeing the policy infrastructure moving at the pace that it will, and corporations responding to that, but also seeing opportunities in their own right, that is beginning that shift. And I see no reason for that, at least from a policy perspective, to change. So the market will inevitably respond to that theme as well, and obviously still beholden to global developments. And this goes back to the notion that the setup for this year is good, but not without risk. But there still is, reason to think under the surface that these trends are moving in the right direction, and we as investors want to be part of that.
Biggest risk is whether AI is or is not a bubble, or at least, is that the biggest risk?
It's up there. It's hard to make a rank order of these. And we've got central bank independence.
Yes.
We've got the Monroe Doctrine reasserting itself in the United States as well. So there's a lot of things that can still go bump in the night, to quote Jeff Moore.
Sure.
But ultimately, I think when you want to look at the way the world is set up, again, the economy is a really important part of it, and the economy is okay. So now we're trying to chase down these various policy risks and wondering, first, are they likely to be realized? And second, is the knock-on effect significant enough to not only impact just the market, but could it also then spill into the economy more generally? And as we assess those risks over the course of the year, that will be the catalyst for us to evolve our positioning.
Speaking of Jeff Moore, things to go bump in the night. Tell us a little bit about asset allocation in terms of your exposure to equity, and,
Sure.
and what about bonds, just to make sure that you're covered?
Yep, no, we can't forget about bonds at
Yeah.
all. So I mean, really our positioning hasn't changed very much relative to the latter part of last year. So really there's just two main views that we're trying to express. The first is being overweight beta and overweight equities. Again, the economic backdrop is sufficiently benign. We are very, again, tied into that AI theme and working with managers to help, again, calibrate that position accordingly. But generally speaking, we're overweight risk. So we have that position overweight to equities and underweight bonds by association. And then the second theme is just being underweight US dollars and expecting that US dollar to continue to depreciate. And we have some of that, again, expressed explicitly across currencies. But I think one of the cleanest ways to play a weaker US dollar story is just an overweight or an allocation to gold. And we've had a fairly hefty allocation there. It's remained consistent through time. And that's just the cleanest way for us, again, to play the risk that we still see the US dollar moving lower. Not necessarily in a straight line. These things always have volatility, but as a balance of risk, I think you still see less dollarization in the world and a push more towards alternative currencies like gold in that context.
And so you'll use the incredible portfolio managers that are at your discretion here at Fidelity, but you overlay with things like commodities. You'll also take a look at inflation protected bonds where that's needed. So this is the actual commodity gold. You take a look at, I guess, gold miners through various portfolio managers.
Yeah, so the underlying managers can make the call on
Sure.
the miners themselves, but from our pure play position, it's easiest just to own the bullion, in which we do it in ETF form.
And you do it in ETF form. Really, really interesting. It has been astonishing watching the price of gold do what it's done over the course of the last year. I guess the question is, going forward, is it just as likely to do just as well for all the reasons that you're pointing out? It sort of sounds like the same case is there.
Yeah, as an investor, when an asset class goes parabolic, like the price of gold has, I mean, it's uncomfortable because, especially with gold, because you can't tie it to sort of those more traditional financial fundamentals like a balance sheet or earnings or dividends. So you have to go into
currencies, essentially.
Exactly. You go into a world of at least more nebulous type of correlations that themselves can be pretty fickle and volatile. Because we remember it wasn't that long ago that it was a well-established correlation between gold and real interest rates.
Yes.
And then that really broke down, and then it became a correlation between gold and central bank buying. And I think that's still an important theme. But if you just look at all those different catalysts that have driven gold, again, you just look at the balance of risk. And is the world going to get more peaceful or potentially more volatile? And unfortunately, we're weighing on the side of it becoming more volatile and more uncertain. And that traditionally, I think, is still a pretty good reason to have gold as part of a portfolio. So these things will never go to the moon necessarily, but ultimately as a diversifier to risk, because that's, again, a really important part of why we have an asset in our portfolios. It's not just to contribute to return, but it's to diversify the more traditional benchmark components of equities and bonds. And that's really why I think gold is an important part of that part of that mix.
A couple of pieces of developments in the U.S. So the midterms will be later on this year, and some of your thoughts on that. Also, the IEPA, which is the Supreme Court, may be overturning the whole underpinning of U.S. tariffs. We don't know yet. Each of those, you'll watch those how they're important. I mean, one of them would be a real mess to have to pay back the tariffs, wouldn't it?
Yeah, that's going to be a logistical nightmare if that comes to pass. But where we've come down, at least on that, is that even if IEPA is ruled to be unconstitutional, there are enough other tariff provisions within the executive office that you can more or less offset all of that with different and new tariffs. So again, it's a headache for the lawyers and all the bookkeepers when it comes to putting all that together, but it doesn't really change the wider narrative that we talked about earlier, where the US is relying heavily on tariffs as a source of revenue, and one way or another that will remain in place. So that's the IEPA story, and the Supreme Court is resuming its session on Friday of this week, and I think it's fairly high on their docket list in terms of what they will be able to rule on. So we're kind of bracing for obviously volatility around that, but again, the undercurrent is that there's still other tariff provisions that will not really change, I think, how the U.S. will approach tariffs and trade more generally. And then on the midterms...
Yeah, on the midterm, I mean, what do you want out of that? Usually investors want nothing.
Exactly. No, I mean, it's hard enough to try to forecast the economy and financial markets. To overlay that with politics is next to impossible. But I mean, you traditionally see, the party that wins the last presidential election loses some ground in the midterms, at least when it comes to Congress and the Senate. So, we'll see how that unfolds ultimately. But I think, this is also a administration in the U.S. that has been very much driven by the executive office. So less has been required of Congress, to put it sort of cynically. So it may certainly add a little bit more in terms of political commentary and a lot of potential, I guess, I would leave it as commentary. And doesn't necessarily flow through to the application of policy, which again seems to be very much concentrated within the White House.
So leading is possibly to a version of gridlock, which just for the purpose of continuing to trade without too many changes in policy coming along is generally good for markets.
No, absolutely. Yeah. I mean, you want to have at least a direction of policy, but if that's going to be disruptive and very volatile, to the extent to which Congress is still relevant, gridlock is maybe not the worst scenario for us today.
You've got a paper coming out from GA. You guys are working on this. You and Alon and David Wolf. What are sort of the big pieces of it? I think AI is one of them, which we did touch on. What else?
I mean, that's question number one. So
is that question number one? Okay.
As always, we start our new year with questions for advisors that are top of mind for us and that shape the way that we're viewing the world. And the first topical question is AI. Is it a bubble? Because as it touches so many parts of the market and there's so much attention on it, it really does, I think, drive the narrative that we expect this year. And we've touched a little bit on some of the things that we're looking at and some of the decisions that we've made around that theme. But also, we're speaking again about the US dollar and the direction of the risks that are embedded within that, and that has a knock-on impact on positioning. And then the third real major theme, and we've talked about it as well, is just how we're viewing Canada. So again, that optimism has progressed as time has gone on. Our allocations have shifted with respect to how we view Canada. So we just want to make sure that we're giving everybody our top of mind thinking on that as well. So that's the genesis of the paper that will be coming out next week, I think.
Coming out next week. Okay, we'll look forward to that. And you're neutral on Canada, which is quite a big change from a couple of years ago where you were deeply underweight. Is that
it leads to the natural question. When you start becoming outright overweight, and again, we just need to see progress. So we talk about the darkest before dawn. So we need a few more rays of sunshine poking over the horizon to really give us that motivation to take a larger allocation there.
What's that mean? Like, just give us a little bit of a hard example there.
Yeah, I think part of it is time. So honestly, as we're working through the housing market cycle, so that's another real headwind to Canada's economy. We are getting towards the end of that 5-year reset from very low COVID level interest rates. So once we get beyond some of that, I think you'll start to see a little better position for household balance sheets, so a little more discretionary spending on that front. Obviously, the labor market has to hold up fairly well, and it's done a reasonable job of that, but we want to be just, again, confident that that's taking place. And then ultimately, it's the tariff story. And as NAFTA is renegotiated, where are we left in terms of A, the level of tariffs, but B, the degree of certainty that now companies can start to invest and hire based on that knowledge that they have a reasonable amount of confidence that the rules of the game won't be changed after a tweet.
Yes, yeah. Less moving of goalposts would be nice. For investors, actually, we finished off last year talking a little bit about investors getting information online, lots of different places, which is all very, very good. I wonder if you just have a note as we start off the year for how investors do collect in a truly data-saturated world. Doesn't mean it's all good data. What would you suggest?
Yeah, this was sort of driven home over the holidays where, you spend a lot of time with family and friends, not all of which are portfolio managers. So you get a little bit of a sense of where people are drawing their information as they're asking you questions about the market and about the world. And I was just really stunned, and maybe I should have known better, but there's so many rabbit holes that exist out there where people are getting questionable information from unreliable sources, and that really is forming people's opinions. So the fact that we're able to do these again and get back to the cadence of these webcasts, I think is really important, because I think we want to do our best to contribute more signal versus noise out there in the world, and this webcast series I think is a really important part of that.
Well, we're delighted to kick off the new year with you, David Tulk. Thank you, and have a happy new year.
You as well. Thank you.
We'll speak to you soon.
Thanks for watching or listening to the FidelityConnects podcast. Now, if you haven't done so already, please subscribe to FidelityConnects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. Well, on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.